Well, good morning. I made a mistake and clicked off of my picture. I wanted to say hi to you in person. But Jim Barlow, I'm here this morning. They call me these days the alchemist. I transform life insurance into a powerful tool to help clients achieve their financial goals. And today, the title is Maximizing Your Retirement. Reduce your 401k contributions to increase income. That sounds interesting. An alchemized approach to secure your future. Let me get those things at the bottom off the screen. Another possible name for this presentation today is more from less. More retirement income from less contributions. That sounds interesting. You know, we're living in a world where we can get more from less. Look at the music streaming. More music for less money, Spotify, Apple Music, Amazon Music. You don't need to buy CDs and cassettes and all this stuff up to date we used to. Global streaming platforms, more content for less infrastructure, Netflix, Amazon Prime, Disney, Apple TV. Amazing. Travel enrichment, Verbal, Airbnb, financial access, Robinhood, Acorns, Stash, connectivity, Zoom, Skype, e-commerce, Amazon, eBay. Wow, the world has changed in my lifetime, and it'll continue to change. And you'll see something today that I think you'll find pretty interesting. So more from less. So what is the smartest path to financial security? Let me show you the different ideas and what you can do. Spend less. Now, this is not being funny here. We're in a spending society. We like to spend. Me too. We need to spend less, and that'll help us. When my children announced to Barbara and I that they were engaged and they wanted to get married, I told the new potential in-laws and my daughter or son, I said, okay, here's a book. Before you get married, I want you to read The Millionaire Next Door. And I gave it to them, and I thought all of them read it before they got married. But about a year after someone's marriage, a daughter came to me and said, "Dad, I got to tell you, we didn't read it." This is a really important book. I hope everyone, if you haven't read it, that you do. We need to learn to spend less. Save more. Well, that's an obvious one. Is tied together with spend less. A part of all I earn is mine to keep. From the richest man in Babylon back in 1926. This was the book I was planning to give my kids when they were getting married. But after I read The Millionaire Next Door, I gave up on giving this one. Actually, I'm giving this to them now when they do get married afterwards. So I want them to have both. Earn more. Well, sure. And sometimes we haven't got the education. We don't have the skills to earn more. The best investment you can make is in yourself. Warren Buffett said that. And I'm sure you're telling your kids the same thing. Get all the education you can. Take more risks. Well, as an investment advisor for 35 years, and people are coming to me whether they're in their 60s or something, I said, I don't have enough for retirement. I've got to take on more risks. Show me some ideas. That's dangerous to take on more risks. Pigs get fat, hogs get slaughtered, is a Wall Street saying. You got to be careful about taking on more risk. Work longer. Well, I understand that. I sold my business when I was 67. Didn't enjoy this new retired life, so I started OakTree Premium Finance. Um, but a lot of people have to work longer. I did not. I have sufficient today for my lifetime. Um, Work gives you meaning and purpose. Life is empty without it. That's certainly me. But some people just have to work longer. Some people have to be the greeters at Walmart. Die sooner. Well, I guess I shouldn't have put that one up there, but it'll solve the problem. Do not say what is left after spending, but spend what is left after saving. Wow, that's a kind of a interesting phrase by Warren Buffett. If you want to read a great biography about Warren Buffett's life, The Snowball, Warren Buffett and His Business of Life by Alice Schroeder. Great book. I seem to feel like I like biographies and autobiographies more than anything else I read. Well, spend less, save more, earn more, take more risk, work longer, die sooner. Is there another way? Well, I'm going to show you another way by adding a protected growth account. Yeah, you're saying, what is that? Well, let's give some background and then we'll get into telling you what a protected growth account is. The problem with 401ks. Taxes in retirement will likely be higher. National debt and government spending point to potential future tax increases. 401k contributions defer taxes, which could cost more later. The problem with required minimum distribution, RMDs, if you're over 70 and 73, you know about these. You're forced to withdraw from your taxable IRAs. You're forced to pay taxes. Sometimes it's not convenient. Sometimes you didn't want to. And last, sequence of return risks. This, I probably should have bolded this one. Market volatility during retirement could drain 401k balances faster than anticipated. You just can't say, let's say you made 8% average for the previous 40 years. And, oh, well, I plan on make another 8% per year. That doesn't mean you can just take out 8% per year because of the sequence of returns. If we just had a 2008 where the market went down 37% and you're taking 8% out after it's gone down, you're going to destroy your retirement. Sequence of return is a big problem. It's a different ball game once you retire. The future tax risk. Do you want to pay taxes on the seed or the harvest? A field of crops representing tax-deferred growth in a 401k versus tax-free growth in a Roth IRA or Index Universal Life. Paying taxes on contributions now, the seed, can save significantly compared to paying taxes on withdrawals later, the harvest. And I was in that boat of, I want to say taxes today. And I ended up with not as much as I want in the tax-free boat. So don't eliminate your 401k, just reduce it. Maximize your employer match. Always maximize the free money from your employer. Reallocate excess contributions. Shift excessive contributions, what exceeds the match, into a protected growth account. So, let's see what this is all about. So a protected growth account. I want principal protected so that you can pull money out of this account in down market years. Preserves your investment by avoiding withdrawals during market declines. Sustainable income, support withdrawal rates. I'm sorry. Have these alarms to make sure I'm on the ball. Sorry. Support withdrawal rates up to 8% in favorable markets conditions while maintaining financial security in down years. With a protected growth account, I believe you still can take out 8%. Enhance retirement stability. Protect your retirement income by maintaining a higher standard of living by reducing reliance on the volatile markets. So, principal protected. We have savings accounts. They're principal protected, certificate deposits, money market accounts, U.S. Treasuries held to maturity, government-backed bonds if held to maturity, fixed indexed annuities. And then there's protected growth accounts. Not a lot. I found 2. Principal protected structured notes and indexed universal life insurance policies. And the protected growth account I'm going to be highlighting is the Index Universal Life Insurance Policy. My main product, as some of you already know, is called Kaizen, and I'll show you. You're not going to hear a lot of the details on that in this webinar, but you can go to my other webinars on my website and get a lot more detail. I have a lot of my retirement money in principal protected structured notes because I can still buy those. I can't buy the Index Universal Life Policy. So here's a little bit the pre-retirement and the post. So the protected growth account, maximize employer match, reduce 401k contributions to the max amount to take full advantage of employer contributions. Diversify with a protected growth account, redirect funds that exceed the 401k match into a protected growth account. This account is designed to grow safely and provide financial stability during retirement. Build a safety net. Aim to accumulate a protected growth account balance equivalent to at least 5 years of planned retirement income before retiring, maybe more. Then here's the strategy after retirement. Income coordination. Use your equity portfolio for income during market upturns. Rely on the protected growth account for income during market downturns. Don't take money out when the markets hit a down year. That's the rule. Take it out from the protected growth account. Benefits of the strategy, you're protecting your principal, preserving your investment by avoiding withdrawals during market declines. Sustainable income. This will support withdrawal rates up to 8% in favorable market conditions while maintaining financial security in down years. Enhance retirement stability. It's safer. Protect your retirement income and maintain a higher standard of living by reducing reliance on volatile markets. That's the protected growth account. Kaizen, which you're not getting a lot of detail, but the basic bullet points are you've got market-linked growth, participate in market gains with downside protection, no downside. Leverage growth, more with less. We're going to borrow money. Tax-free growth, index gains without tax liability. You get living benefits, excess funds for chronic critical illness, no contribution limits. High income earners can save more tax-free. And you're not going to get a major presentation on Kaizen today, but there's the real basic summary. So I got to show you how this works. So we're going to do a case study. I've got James and Mary Smith, age 45, filing jointly. James's job is a software engineer making $200,000 a year. Mary is a stay-at-home mom. Retirement age 67. I chose 67 for our hypothetical because that's the age where you're full Social Security. Marginal tax rate 30%. Assets. Jack's Roth 401k has a balance of 300,000. 20% is traditional money and 80% Roth. And Jack's he's contributing to this 401k 20 of his money, 22,000 a year. And I just put in there, he's basically maxing it out for 2025. The maximum he can put in is 22,500. He's about there. And Jack's company matches 6,000. So for 6,000, they match 6,000. That's the case study. We're going to do all the numbers. This is my retirement income gap calculator on my website. And so I just put in the numbers and put in his age, put in his retirement age. You get to, on my calculator, I have it defaulted at 2% inflation, but I increased it for this study at 3. I put in the current income. Most people need 80% of their current income to live off of. So I left that at 80. When you're using the calculator yourself, you can change that to 90 or 100 or 70, anything. And I put in the total accumulation retirement savings of 300,000. And I've got a default anticipated average rate of 7. And you can put that up or down. And then at what age would you project your retirement saving to sustain income? And I have it defaulted at 90, but you can change that to 100 or whatever. So in this hypothetical, this is not considering his contributions. He's the 22,000 per year. This is just saying a snapshot today. How much does he need more in income? And it shows that he needs another, from what this snapshot, he needs another 206,000 income per year. I'm doing a new calculator that I'm going to call this the basic. And the new one that I've already put all the rules together from my computer geek to do it. I'm going to have Social Security in there. I'm going to add the contributions. I'm going to add different withdrawal rates. It'll be a little more advanced. But this is the one currently. I'd like to actually go to my website for a second and show it to you. Let me change my screen. This is my website. And notice there, we're on the Thursday, January 23rd, 10 a.m., this webinar. And if you scroll down a little bit, if you want to know more about Kaizen, you could watch this webinar called Transforming Your Life Insurance into an Investment, where you can come to a live presentation. And if you go a little further, you got the quick links, and the top one is Retirement Income Gap Calculator. So I'm going to click on that, and here it is. Just to show you how easy it is to use, and then we'll move on. So let's do something a little different from the guy we're doing. Let's say you're, let's start with a 25-year-old. You're 25, and you do think, and you want to retire at 60. Let's do 60, and you think inflation will be 3, and your current income, what do you think? 150,000, just graduated from college, good income. 150,000, and then I left the 80%. If we wanted to do 81, whatever, I'll leave it at 82. So this shows you his target income at age 60 is 346,105. Now we're total accumulated 25. Probably not. Well, I'm going to leave it at 0 at 25. And we'll, let's say we can get 8%. And instead of 90, let's say this person, I'm not, I hope let's go 95. And I don't have to actually push the calculate because it did it already. And so this person is short the whole amount. See that? And if we put that they had some money, let's put in 100,000. Immediately, another 0. Then it immediately grows 100,000, and it's going to grow at 8% to 1,478,000 with no additions. And we'll give 101,000 income to get against the income. This calculator is just on my website for anyone's use. Just use it. Your discretion is just there. And there'll be a new one soon, a little more complex. Let's go back to our other page. Got to get to the right place here. Okay. Okay, this was what we already figured. So here's where this individual is at. If he leaves things alone, just like he has targeted, his with the yearly payments of 28,000, the 22, and then the 6 from the employer, at 7% growth, that will grow to at age 67 to 1,372,160. I should put another comment in there. So, and then the previous accumulation from the calculator is 1,329,000. So he'll have a total assets at age 67 of 2,701,381. Now, can he withdraw the 8% we've been kind of talking about? If this is his retirement account, no. If he does, that 206. Remember his target was 200. It was 206. So he'll make it on what he's doing if he can pull out 8%. But I would say it's tough, and he'll probably blow it up. The safe withdrawal rate in the investment world is considered 4%. It was proposed back in 1994 by a CFP, Bill Benken, wrote a book on it, and everyone except investment advisors accepted this and understood it. And retirement planning guidelines suggested retirees could safely withdraw 4% of the portfolio value in the first year of retirement, adjusting annually for inflation to ensure their savings last at least 30 years. Based on historical U.S. market data, the rule assumes a balanced portfolio, 50 to 75% stocks, to the rest in bonds. That's what you can withdraw safely from an all equity that has downside accounts. So here's my proposal for this person. Reduce the yearly payments to 6,000 from the 28. Still getting a match of 6,000. And that account now is going to grow to 588. And then add the previous contributions, the total will be 1,977,000. And if now I'm proposing 8%, because we're going to have this other account we're going to establish on the right side. I'm planning on pulling out 8% out of this in the up years, 153. So available from reduction is 16,000, not changing his contributions. I got a problem using my Kaizen. The minimum Kaizen at age 45 is about 22,000 a year. And remember, for those who have attended a Kaizen presentation, it's for 5 years only. Anyway, so I can't really set up a 16,000 Kaizen for him. But here's how I did my calculations. So I doubled that 16,000. I'm going to cut it in half in a minute to 32,000 for 5 years. And Kaizen is building equity and debt, and we're going to be making money on the debt. And so at the end, at age 67, assuming this 7% return, same numbers as there, but withdrawing 8%, 8% from the equity and 2% from the debt, we can pull out per year 67,404. Now that's putting in 32. If we pull out half of that, which is 16, which he has available, and we can pull out 33,702, and that adding the results of number 2 on the left, he could have income of 187,077. That's higher than 108. So I've increased, in my opinion, safely his retirement income, about 80,000, pretty good, where the 8% in the one account would have been very aggressive and dangerous. So I did another calculation. I'm sorry. This is the one we did. See the 205,706? And remember here, he's at 187. So that 187, what I've replaced this fund with is not quite enough. So I need to do another calculation. Kaizen has an online calculator, and there's a quick result calculator, there's a custom design calculator. You have to have a login and password to go to the site. Anyone can once they have the login, no cost or anything. And I can set you up to have one of these accounts. Anyway, I want to do the custom design, and here's what I did. I've done this before, and I put in 25,000 a year for this person. So I raised his 16 by 9,000 a year, to 25,000 for 5 years, not the whole 22 years before retirement. And the Kaizen will be borrowing 331,370. So we'll be putting in 456,000 into the investment. And here's the results. The middle shows at age 67 how much he can start pulling out, 54,000 a year. 54,000 add to the 180, 54,000 add to the I'll have to put my numbers, but actually it made the grade. And he'll have initial death benefit of 666,000. He'll be able to pull out 54,000 tax free. Age 90, he'll pull out 1,296,000. And comparing investing and other avenues, there's the 54 in the blue box one, the Kaizen. But if we bought the same index life without leverage, it'd be 33,000. If we did a regular investment, 23, and if we did an IRA 401k, 30. So we've with a little bit more money, we've actually met the client's needs. Final key takeaway: minimize your 401k contributions. Doesn't mean saving less, it means saving smarter, diversified. A tax-free retirement strategy puts more money in your pocket. If you'd like to be invited to that portal, I need your name, cell phone number, email address, and birthday. Once I receive that, I'll send in the invitation will be going in, and you'll receive it from my Ilya. And that's my information. I think that's probably, I was wondering if we should do anything more today, but I think we'll call it quits. Thanks for attending this webinar. And as you have questions, just email me, call me, whatever, and have a great day. And you're welcome to come to one of my public presentations on alchemy and Kaizen. Have a great day. Bye.